Okay, now let's go ahead and look at some examples. Now, one thing I want to let me go back and repeat the basic premise for this method, the Muathe Virgin breakout. It really is dependent on a 200-day moving average that was dropping, goes flat, and the only way this 200-day moving average can turn around and head higher is if price moves higher. So what we do, we set a bait. We wait for the stock to close above the 200-day moving average. So now it's flat. It has to decide whether it wants to go down. It can't continue being flat forever, right? I mean, it can go flat for a long time, but at some point it either has to go up or down. So what we do is that we use the highest close above the 200-day moving average as our entry point. So moment the stock starts to show signs of moving above this highest close above the 200-day moving average, then we know that more than likely this 200-day moving average is going to resolve to the higher side. Now the beauty of this is that the 200-day moving average is like a mother sheep. It doesn't move much, and when it moves, it usually stays in that direction for a while. So you can see how this method mathematically makes a lot of sense. So when the stock moves above that range, this sheep is turning around, and you're going to be seeing higher prices for a while. It might not seem like that from day to day, but eventually when you look back, this is going to be one you might want to hold for a medium-term position or a long-term trade. Now, let's look at some examples. Yeah. Okay. Now, one thing in this example, we see that first and foremost, there was the indication that the stock here might have had intentions of forming crossover, right? At this point, you did not know what was going to happen over here. So this was moving higher. So you didn't know, you might have thought there was going to be a crossover here, and this could have been a trade. Thing about it is that once this stock comes here and we see there's a flat 200-day moving average, the stock, even if we use that as an entry point, we never get a move above that point. So this was not one you could have played. Another thing you need to note is that also here we don't see the 50-day moving average showing us any sign of rest. We need the stock to rest before it moves. Rest is essential. Now, notice the second setup. First, we notice a flat 50-day moving average. Good. And then we see a flat 200-day moving average. So in this particular example, the only way this 50-day moving average can cross over the 200-day moving average is if the price moves higher, substantially higher. So we use this close above the 200-day moving average as our entry point once it settles down for a couple of days, and once it moves there, we use that as our entry point. Number one, the stock settled down again, and you see we still have a flat 200-day moving average, so we use that close there again after a couple of days of rest as the next entry point. So we get entry point there and an entry point there. And also another thing that on this example we observe is that the RSI also makes a move to 68, and actually seems to be getting out of this lower lows on the RSI, and it shows intention of moving above that. So this seemed like a nice trade in late 2005. Now let's go back and see what happened after that. So the prior chart was in the lower 20s. We move out of that flat 200-day moving average. We eventually got our crossover as we had anticipated, but notice what happened. Flat 200-day moving average, it turns around. Stock moves from around 20 to a good $42 in under 3 months. It's a good gain, and eventually it makes a high of around 52.50. So this was a nice move based on that simple method. Now let's go back and then look at another example. Now this one is one that I actually played this breakout for for my members, and we see that I take that back. Maybe I don't know what I'm talking about in terms of exactly where we traded this. I think I was playing this right here. But anyway, in this example, I put 3 arrows because I wanted to remind myself to show you something. In this example, you could have also played the 50-day moving average that was flat here, and the highest close above that could have been a nice entry point. But you know that because this 200-day moving average is still dropping, that it needs to settle down. So you could have played this bounce to somewhere around here. It's a short-term trade for a couple of dollars, and it moved from around 14.50 to around 18. It's not a bad gain in I would say a month, under a month. But anyway, so using our Muathe Virgin breakout, you see the 200-day moving average comes down, forms this nice long flat 200-day moving average. So now we know more than likely, because it's been dropping, it's flattening out. So the highest close right here was our entry point, and the stock moved. And usually we get this kind of uncertain action because of stock's been dropping for a while, so it has some negative weight on it. So but anyway, this would have been our entry point, and I think this is where I brought it to my subscribers. So 18, stock moved to around 22. Now let's say you are still holding, and I'm sure it happens. I'm not saying, and I put this out there because sometimes they fail, but I want us to go back and see how we can still play them. So let's say you are still holding, and you didn't sell, and you still found yourself having to take a loss around here. It happens. The thing about it is that around here, again, you see a small flat 200-day moving average. We could have also used, had we been following the stock, let's say you still like the sector, you like the stock, you want to get back, you have been shaken out, use this highest close above the flat 200-day moving average. Now remember, the only way the 200-day moving average can keep going higher is if prices move higher. That's the only way. Otherwise, this thing can go flat and drop. So we know we have this flat 200-day moving average, a slight move, another small pause, which is flat. And so we know the only way this can go higher is if prices move substantially. All right. So now we use that as our entry point. That was the highest close above this flat 200-day moving average. So somewhere around here, we could have re-entered the stock. Now let's go back and look at what happened. There's nothing of note on this. So after that, the stock moved from, let me see, from around right here. Actually, it was somewhere around here, if I'm not wrong. So somewhere around there. And notice also, we had a flat 10-month moving average. Now, I need to point this out. I almost forgot. This is important. You can also use a flat 10-week moving average. Use any close above that, or sometimes even slightly below that, on a flat 10-week moving average. Once this 10 close on a weekly basis is broken, that becomes an entry point. So on this example, let me erase that stuff. You see this flat 10-week moving average. So we can say somewhere around this close here. Wow, let me draw that again. This close right here, you could have used that as an entry point. It has to be flat. Again, you can always confirm this with the daily, but that's just something you can also add on to your it takes a couple of minutes just to check that, but a flat 10-week moving average also shows a sign of rest. But anyway, in this example, we re-entered the stock again here, just under 20, and the stock has went on to trade as high as 50, and is still not done in after the first quarter of 2008. So there might be some more. Point of it is that we use that method to enter back into the stock. Now let's go back and look at another example. Again, we see for many months stock had been forming this kind of flat, meandering 200-day moving average, and at some point we have this nice long flat 200-day moving average. Let me remove that so you can see it. It's right there. And the only way this thing can move higher is if prices move. So this close above that becomes your entry point. And now you see that the 50-day moving average is also flat right there. You can see that. So the only way this can cross over that at this point is you buy the stock during this move right here. This break right here shows that more than likely the 200-day moving average is going to move higher. The 50-day moving average is also going to move higher and cross over, and that's a bullish sign of strength. So you buy the stock here at around 550 in a couple of, probably within a couple of days, if not 2 or 3 weeks, the stock trades as high as $8, and I believe that was not as high as it went. Let me check that, see whether I'm missing something. So then again, so we see that stock moved from 550, went as high as 8, but eventually would go on to trade as high as $15. So that was a great gain for the stock. Now next up, let's look at another play, and I remember we played this one perfectly in late 2000 and early 2006, I guess. Linux had been forming this flat 200-day moving average after falling for a couple of years. Flat 50-day moving average, classic. This is a classic. So the only way around this point that this could have crossed over and the 200-day moving average could have turned around was if prices moved higher. So you use this close, highest close above the 200-day flat 200-day moving average right there, and you enter the stock right there. Again, you see after the initial breakout there's this shakiness, but that one for the most part it held. So you enter the stock there just under at $1.90, and within, it's right here again, so within, you enter the stock at around $1.90 right there, and within I think a couple of weeks the stock went on to trade as high as $6. That was a big gain based on that one simple method. All right, so it's powerful stuff. Okay, bad. I think that's pretty much it. All right, so that was what I wanted to show you. Keep in mind that you can always tweak it. You can always combine other factors like market, how markets are doing and stuff like that. I hope I've kind of brought this to where I've explained it. Wait for a flat 200-day moving average. The only way it can move higher is if prices move above the highest close above the 200-day moving average, showing as a sign of strength and intention to move higher. This is Eric Muathe. As always, peace and blessings to you. See ya. I am